We've had a forecast of about 1,800 for quite some time now, and I suppose the upside risk case to gold is around that sort of 1,900 to 2,000. But I want to bring it back to first principles when it comes to gold. The key drivers for gold are generally three things: market sentiment, the real US interest rate, and the broad dollar. And from those perspectives, the setbacks we've seen in gold in the last couple of days have largely been around improving of risk appetite. You see the equity market pick up, the VIX continues to fall back. But the next leg for me in gold up is going to be driven by an improvement in inflation expectations in the US. Now, it's a bit early to talk about that yet, but as we go into the third quarter, oil prices, gasoline prices are recovering. We start to see industrial production start to recover. So manufacturing begins to pick up. And so those things will improve economic and inflation expectations. And so you will see real interest rates. As the Fed says, we're on hold for a material period of time. You'll see real interest rates dip deeper into negative territory, potentially around the negative 1% on the tips as a proxy. We're currently sitting around the 0.3, 0.4, and so that should push gold prices to around the 1,800s. Where do I see the limitations to gold prices moving higher here is mainly from the monetary policy side. So do we expect the Fed to do even more easing going forward? Well, if the economy does not rebound, that is indeed will be the case, and that will push gold into that sort of 1,900 to 2,000. But if the Fed are comfortable with their position, if the economy begins to recover, then the next step for the Fed is to talk about how do they begin to remove some of that stimulus from the economy on a 12-month basis, and that would likely limit the upside to gold.